If you want to trade like institutional traders, getting accurate entries by aligning market structure with supply and demand zones, there's one powerful concept you also need to understand: liquidity. So, in this video, I'll walk you through a clear 6-step formula that will help you spot liquidity and use it to improve your entries, just like the institutions do. I've used this exact method to take clean, confident trades, and I'm sure it can help you become profitable too. Let's jump into step 1. So, step 1. How institutions manipulate the market. Have you ever noticed how your stop loss gets hit and then the price shoots up without you? That's not just bad luck. Let's say the market is going up, making higher highs and higher lows. Many traders put their stop losses just below those higher lows. But here's the catch. Those stop losses are actually hidden sell orders. That's called liquidity. Now think about the big players, like banks or hedge funds. They don't trade small amounts. They trade with huge money. If they try to buy during the uptrend, their big order could push the price too high. So, what do? They look for spots where lots of sell orders are waiting, like under those higher lows, and they push the price down just enough to trigger those stops. When the sell orders hit the market, the big players quietly buy them up. Then the price moves back up, and they're in the trade without causing a big move. The next place they're aiming for? The stops above the last high, where short sellers put their stop losses. The price moves up quickly to that level, and the big players use that area to sell and take profit. This is the pattern. They enter when others are scared, and exit when others are chasing. As traders, we don't need to predict every move. We just need to learn how to follow what the big players are doing by reading the trend, spotting strong areas, and watching for liquidity. Once we do that, we stop guessing and start trading with real purpose. Now that we understand what liquidity is and how big players use it to enter or exit quietly, the next step is using that knowledge to build smart trades. This is where everything starts to connect. Every trade we take is built on 3 key pillars: market structure, zones, and liquidity. Let me show you how they work with a simple downtrend example. Imagine prices moving lower on the 15-minute chart, forming lower highs and lower lows. That's structure, our first pillar. It tells us we're in a downtrend, so we focus only on sell setups. No guessing, no going against the flow. Structure gives us direction. Now price pulls back into a supply zone, an area where sellers were strong before. That's our second pillar. Zones. They help us spot likely turning points. But here's what most traders overlook. Not all zones are strong. This is where the third pillar, liquidity, changes the game. Right before the supply zone, we see a clear row of equal highs. This tells us that liquidity is building, and that many early buyers have their stop losses there. This makes the area attractive for big players who want to place large sell trades without moving the market too much. So they let the price rise just enough to hit those stop losses, which triggers buy orders. At that moment, they sell into those buys. Once done, and the trend continues. This move isn't random. The market structure shows the direction. The zones show where it might happen, and the liquidity tells us when. When all 3 come together, we're no longer guessing. We're trading with purpose, following smart money, and using a setup that actually makes sense. So now that we understand how big players think and why liquidity matters, step 3 is about bringing that insight to the chart. And it starts with one simple question: where's the liquidity hiding? Because once you can spot that, everything changes. You stop chasing price and start following where the real moves begin. Here's the trick. Liquidity usually builds up just above clean highs and just below clean lows. That's where most retail traders place their stop losses or breakout orders. And that's exactly what smart money targets. So think of it like this. Buy-side liquidity sits just above obvious highs, and sell-side liquidity hides just below obvious lows. It's simple, but powerful. To make this even clearer, let me walk you through a simple example. Imagine price is in a downtrend and forms 2 equal lows, what we call a double bottom. Now, a lot of retail traders see this and immediately think the market has found strong support, so they start buying. But under the surface, something else is going on. Just below those 2 equal lows lies sell-side liquidity, stop-loss orders from early buyers, and sell stops from breakout traders who expect price to keep dropping. Smart money knows that. So before the real move-up begins, price often dips just below the double bottom to grab that hidden liquidity. This quick sweep knocks out weak hands and fills large institutional buy orders at better prices. Then, once that liquidity is collected, price reverses and moves higher. And that's the actual entry point smart money prefers. Not when it looks safe, but right after the liquidity grab. Now let's flip that around with a trap version of the same setup. In this case, price forms the same double bottom, but instead of holding, it slightly breaks below. This tiny move shakes confidence and makes retail traders think the support has failed, so they sell the breakdown, placing their stop losses just above the structure. But again, this is a setup smart money loves. They sell into that breakdown, not to follow the move, but to collect the liquidity sitting below. Once they've scooped up all those stop orders, price doesn't continue lower. It flips and launches upward, catching breakout sellers completely off guard. And this shows us something really important. Not every breakdown is real. Many are carefully crafted fakeouts designed to trap traders who chase price without understanding what's really happening. Another example is when price forms a strong low, then gives a small bounce and pulls back again. Retail traders often look for a breakout above the minor high that forms after the bounce, thinking that's their signal to enter. But smart money is watching something else. They're eyeing the liquidity sitting just below that strong low. That's where a lot of stop losses are stacked, creating another pool of sell-side liquidity. What usually happens is price dips below that strong low, grabs the liquidity, and may even tap into a small demand zone sitting just underneath. That's where institutional buyers are waiting. Right after that, price quickly reverses and pushes higher, giving smart money a perfect entry while retail traders are either stopped out or still waiting for a breakout that already left without them. Now apply the same logic to the next three patterns. Start by spotting clean swing highs and lows. If a level looks obvious, it's likely important. You don't need a chart full of indicators, just clarity. Big players leave clues in how price reacts around key levels, not in random candles. Always ask yourself, if I were managing billions, where could I place large orders without being noticed? That's where liquidity hides, and where real setups begin. Now that we know where liquidity hides, just above the highs and below the lows, let's go one step deeper. How does the liquidity get there in the first place? This is where step 4, inducement, comes in. And this part is really important, so pay close attention. Inducement means the market creates a trap. It shows a setup that looks clean, safe, and normal. But it's actually meant to trick traders into entering. The goal? To gather their orders and create the liquidity big players need. Let's take a simple uptrend as an example. Price is moving higher, forming higher highs and higher lows. Then it pulls back and forms a nice little bullish flag. Looks great, right? Most retail traders think this is a perfect breakout setup, so they buy just above the flag and place their stop loss below the recent low. But here's the trick. That breakout isn't real. It's bait. Big players are watching, waiting for traders to enter. Why? Because every stop loss under that flag becomes sell-side liquidity, and they need sellers in order to buy. So what happens? Price breaks the flag, looks like it's continuing up, and then suddenly drops, hits all the stop losses, fills the big orders, and then goes back up again in the real move. Retail traders get stopped out. Institutions get in. That's inducement. The market makes things look safe to trap traders and collect orders. It happens all the time. Double tops, flags, ranges. The key is to stop reacting and start observing. Read between the moves, not just the candles. That's how smart money plays. Step 5. The high-confluence POI setup. Aligning past confirmation with present inducement. Alright, this is where everything we've learned really starts to come together. We're no longer just spotting liquidity or reacting to price. We're now combining past confirmation with present inducement to create a complete high-confluence trade setup. Let's break it down step by step using a simple uptrend example. Imagine the market is trending upward, forming clear higher highs and higher lows. Everything looks bullish at first. Then suddenly, price aggressively pushes above a previous high. It looks like a breakout, but it doesn't last. Instead, price quickly reverses and drops sharply. That's your first big clue. It wasn't a real breakout. It was a liquidity grab. Just above that high were stop losses from early sellers and buy stops from breakout traders. Smart money knows this, so they push price up, collect all that liquidity, and then reverse the market. This sharp move creates what we call a sweep zone, the area where smart money likely sold heavily into that buying pressure. After the sweep, price breaks below the last higher low. This is your change of character, a clear break in structure that signals the uptrend might be over. Now you have past confirmation, a sweep, a reversal, and a structure break. Together, these signs give you a strong directional bias, showing that smart money has likely taken control and flipped the market from bullish to bearish. But that's only half of the setup. Now, we shift to the present. After the big reversal, price starts to move back up again, but this time the move is slower and more controlled. You'll often see price forming equal highs, sitting just below the original sweep zone. And those equal highs aren't random, they're a setup. They're designed to attract more breakout traders, making it look like another strong move is coming. But smart money is setting the trap again, letting liquidity build up one more time. Now we have the full picture. The past gave us confirmation with the sweep and structure break, and the present is giving us inducement, a trap to lure in more buyers. This is what creates a high-confluence setup. This is where we mark our point of interest, usually the sweep zone, which has now become a key supply area. But we don't just jump in. We wait for price to run the equal highs, tap into that zone, and then give us clear signs of rejection, like a strong bearish candle, a structure break on a lower time frame, or a shift in momentum. And that's exactly what happened here, as I mentioned. That's when the setup is complete. Don't worry, I'll break all of this down in the next steps, so stay tuned. When all of this lines up, the sweep, the change of character, the inducement, and the reaction at the point of interest, that's your A-plus setup. You're not guessing anymore. You're reading the story the market is telling, and you're trading in sync with smart money. This approach gives you real clarity. You're using the past for confirmation, the present for anticipation, and the POI for execution. It's clean, it's logical, and it works. That's the power of a high-confluence setup. If you're serious about trading with smart money concepts, then here's something you don't want to miss. Having the right mindset is key, but having the right platform makes a huge difference too. That's why I've partnered with SimpleFX, a broker that's built to make trading easy, even for beginners. There's no minimum deposit. You can start with just $1. It works seamlessly on both your phone and computer, and it's got TradingView charts built right in, so you can analyze the market without needing extra tools. You can trade Forex, crypto, stocks, and more, all from one platform. And if you're new, no worries. They also offer a free demo account so you can practice without risking any real money. Here's the best part. When you sign up through my link and deposit $100 or more, you'll get a $40 bonus to kickstart your account. Thanks to SimpleFX for supporting this video. The link is below. Feel free to check it out and start your trading journey the smart way. Now, let's get into the final step, execution. Liquidity is only ever used to precisely time your entry, nothing more. First, you must clearly identify the market structure. Then, carefully mark out your key supply and demand zones. Only after that should you even consider liquidity. If you skip this sequence and enter just because you spot liquidity, chances are you'll take a loss. That's why I've already made full videos on market structure and supply and demand. Make sure to check those out first if you haven't already. Now remember, all the analysis in the world means nothing without proper execution. That's where mechanical entry models come in. They give you fixed rules to stay consistent and avoid emotional mistakes. I'll walk you through 3 types: aggressive, balanced, and conservative, so you can find your fit and trade with confidence. Entry Model 1, the aggressive limit order. This is the fastest way to enter a trade, and it often gives you the best risk to reward. At this point, you've done your analysis, found a strong POI, point of interest, and see clear signs of inducement building just before it. Maybe there's a clean structural low sitting right above your zone, which means liquidity is likely sitting there, perfect for smart money to take advantage. So instead of waiting for confirmation, you take the proactive route, refine your POI, maybe down to a smaller order block or a tighter imbalance, and place a limit order there. That's it. You set it and walk away. If price comes down, sweeps the low, and taps your zone, your order is triggered automatically. This gives you the best entries in terms of reward versus risk, but there's a catch. You're entering without confirmation. You're trusting your setup completely, and if you've misread the inducement or marked the wrong zone, you could get tagged in and stopped out quickly. That's why this method suits traders who are confident in their analysis, experienced with structure, and can handle a stop loss without flinching. Entry Model 2, the balanced trailing entry. This one strikes a nice balance. It's a little safer than a blind limit order, but still fast enough to catch a great entry without chasing price. The setup is the same. You've marked your POI, and you see clear inducement right in front of it. Maybe there are equal lows, or a recent swing low sitting just above your zone. You know liquidity is building. But instead of placing a limit order and walking away, you wait. You let price do its thing. First, you want to see it sweep that liquidity. Once the sweep happens, watch for signs of rejection. Maybe a big wick, a strong bearish candle, or even a quick internal break of structure. That's your signal. Now instead of jumping in right there, you start trailing your entry just behind the candles as price reacts. You're not trying to catch the exact bottom. You're waiting until the sweep shows clear signs of rejection, then jumping in with momentum on your side. It's still an aggressive entry, but with a touch of confirmation. And sometimes, that small bit of extra confidence is exactly what you need to pull the trigger. Entry Model 3, the conservative confirmation entry. This is the safest and most patient way to enter a trade. Perfect for traders who want solid confirmation before committing. Here, you let everything play out first. Price sweeps the inducement, taps into your POI, and you wait, not rushing in. What you're looking for is a clear shift in structure. If you're planning to go long, maybe you see a break above a recent high, or on a lower time frame, you spot a solid market structure shift that confirms buyers are stepping in. Only after that confirmation do you get ready to enter, and even then, you still wait for a pullback. Maybe price creates a new demand zone, leaves behind a fair value gap, or aligns with a key Fibonacci level. That's your entry spot. This model gives you a high probability of success because you're entering after the reversal is clearly confirmed and the trade has proven itself. The downside is that sometimes price just takes off and never comes back for a pullback, meaning you might miss the move entirely. But if your main goal is to be right more often, not to catch every move, This method can bring you peace, confidence, and long-term consistency. Let's quickly recap the 3 entry models. There's no one-size-fits-all answer, as each method has its pros and cons. What really matters is choosing the one that fits you, your personality, mindset, and comfort with risk. Backtest it, learn it inside out, and most importantly, stick with it. Because when it comes to execution, clarity and consistency will always beat trying to be perfect. Before you go, let me remind you of something really important. Don't rush into trading liquidity just yet. Take a step back and make sure you truly understand the foundation, market structure, supply and demand zones, and how to spot high-probability setups. Not the weak or random ones, but the ones that align with smart money principles. That's where your real edge begins to form. So, what's the next step? The next video is right here. Go ahead and click it to continue learning how to trade the smart way.